Friends, today we're going to talk about something that touches our lives every single day, whether we're saving money, borrowing for a car, or even just checking the news: interest rates. So, where do these numbers come from? Is there a secret room where a few people decide them? In reality, interest rates are a dynamic reflection of a fundamental economic principle: supply and demand. Think of interest as the price of money. When the demand to borrow money is high, because businesses want to expand or people want to buy homes, and the supply of available money is low, what do you think happens to the price? It goes up. Conversely, when there's a lot of money available to lend but not as many people or businesses are looking to borrow, the price of money, the interest rate, tends to fall. But it's not just a simple market. We'll explore how powerful players, like a country's central bank, can step in to influence this delicate balance, using tools like monetary policy to control the money supply and shape the entire economic landscape. We'll also look at other factors, from inflation to risk, that play a crucial role in determining these all-important numbers. An interest rate is basically the cost of borrowing money or the return on investing it. It's always expressed as a percentage of the principal, which is the original amount borrowed or invested. For example, if you borrow 10,000 Cuban pesos with a 10% interest rate, you'll need to pay 1,000 Cuban pesos on top of the amount you borrowed. Now, why is this important? Interest rates play a big role in how financial markets and even the whole economy function. For lenders, it serves as their compensation for allowing others to use their money and for taking the risk that the borrower might not pay back. For borrowers, it represents the price they pay for accessing funds they need. To make this more concrete, let's look at Jasper's case. He borrowed money to start his laundry shop. The interest rate he agreed to determines how much extra he needs to pay the lender. That's the lender's way of being compensated for the risk and for giving up the chance to use that money elsewhere. So, whenever we talk about borrowing and lending, the interest rate is the bridge between the lender's gain and the borrower's cost. Let's now look at how the Bangko Sentral ng Pilipinas, BSP, influences our economy through interest rates. When the BSP lowers interest rates, borrowing becomes cheaper. This encourages people to spend more and businesses to invest in expansion since loans are more affordable. As a result, it helps stimulate economic growth. On the other hand, when the BSP raises interest rates, borrowing becomes more expensive. This discourages spending and investment, which can slow down economic activity, but it also helps control inflation. Now, let's connect this to the financial markets. Lower rates often lead to higher stock prices because companies can finance projects more cheaply, boosting profitability. In contrast, higher rates can drag stock prices down since costs increase and profits shrink. For bonds, the effect is the opposite. Bond prices rise when rates fall, and they drop when rates rise, because the fixed returns of bonds become more or less attractive depending on the prevailing rates. So, in short, BSP's decisions on rates ripple through borrowing, spending, investments, stocks, and bonds, shaping the overall economy. When we say that rates remain constant over the life of the loan or investment, it means the percentage you agreed on at the start will not change, no matter what happens in the economy. The main benefit of this setup is predictability. You know exactly how much you'll pay or earn, which makes financial planning easier. For example, if you take a 5-year personal loan of 10,000 Cuban pesos at a fixed 5% annual interest rate, you will pay 500 Cuban pesos in interest each year. This amount stays the same for the whole 5 years, even if market interest rates go up or down. So, you're protected from sudden increases, and your payments remain stable. In short, fixed rates give you security and stability, which is especially helpful for budgeting and avoiding surprises in your finances. Let's now look at the common applications of fixed interest rates. Fixed rates are often used in mortgages, car loans, and certain bonds. These are financial products where people usually want stability because the payments last for several years. Imagine paying for a house or a car. You wouldn't want your monthly payments to suddenly increase just because market rates went up. The big advantage here is protection. When interest rates in the economy rise, those with fixed-rate loans don't feel the impact. Their payments remain the same, while others with variable-rate loans might end up paying more. So, having a fixed rate is especially beneficial when interest rates are going up. It shields borrowers from higher costs and makes long-term commitments easier to manage. Unlike fixed rates, variable rates change over time, depending on movements in a benchmark rate such as the prime rate or other market indicators. This makes them less predictable compared to fixed rates, since your payments or returns can increase or decrease as market conditions change. For example, imagine a 10-year adjustable rate mortgage, ARM. It might start at a lower interest rate, but it adjusts annually based on the prime rate plus a margin. If the prime rate rises to 4% and the margin is 2%, then your new interest rate becomes 6%. This means your monthly payments could suddenly increase, making it riskier compared to fixed loans. The key takeaway is that variable rates can be beneficial when rates are low, but they expose borrowers to higher costs if market rates go up. Let's talk about the common applications of variable interest rates. You'll usually encounter them in mortgages, credit cards, certain loans, and even bonds. The main idea here is that the rate you pay, or earn, changes depending on market conditions. Now, what are the benefits and risks? The benefit is that when interest rates in the market decline, your payments also go down, which can save you money. However, the risk is the opposite. If rates increase, your payments also rise. This makes it less predictable compared to fixed-rate loans. So, the key point is, variable rates can work in your favor when the market is stable or rates are falling, but they can be a burden when rates are rising. A nominal interest rate is the rate you see stated on loans, deposits, or other financial products. It tells us the percentage change in the amount of money earned or owed over time, but it does not take inflation into account. That means it reflects the face value of the interest, not the real purchasing power of money. For example, if you borrow 10,000 Cuban pesos at a 6% nominal rate, after 1 year you'll owe 10,600 Cuban pesos, that's your principal plus 600 Cuban pesos interest. It's straightforward because it's just the stated percentage. Nominal rates are simple and clear, but to really know how much you're gaining or losing in terms of purchasing power, we also need to consider inflation, which leads us to the concept of real interest rates. Unlike nominal rates, which only show the stated percentage, real interest rates are adjusted for inflation. This means they represent the actual cost of borrowing or the true return on an investment in terms of purchasing power. The formula is simple. Real interest rate equals nominal interest rate, inflation rate. For example, if you have a 5% nominal rate but inflation is 3%, the real interest rate is 2%. This tells us that even though you're earning 5% on paper, the actual increase in what your money can buy is only 2%. The benefit of looking at real rates is that it provides a clear picture of financial impact, whether you're borrowing or investing. It helps in making more informed financial decisions because it reflects the genuine cost of debt and the actual returns on investments. So remember, nominal is what's written, real is what truly counts in terms of value. Meanwhile, the prime rate is the interest rate that commercial banks give to their most reliable and credit-worthy clients, usually large corporations. Because these clients pose the least risk of default, they are offered lower rates compared to regular borrowers. Now, what makes the prime rate important? It serves as a reference point for many other types of loans, like mortgages, business loans, or even credit cards. In other words, when banks set their lending rates for other clients, they often base it on the prime rate plus a certain margin. For example, in the US, the prime rate is usually set a few points above the federal funds rate, often around plus 3%. In the Philippines, however, the Bangko Sentral ng Pilipinas, BSP, does not directly set a prime rate. Instead, it sets key policy rates like the overnight reverse repurchase, RRP, rate, and these influence the rates that banks offer to their best clients. The effective interest rate represents the true rate of interest once we factor in the effects of compounding. Unlike the nominal rate, which is just the stated rate, the EIR gives us a clearer and more precise picture of the actual cost of borrowing or the actual return on an investment. The formula is equals 1 plus slash minus 1 EIR sad face 1 plus R slash N minus 1, where R is the nominal rate and N is the number of compounding periods in a year. For example, if you have a 12% nominal rate compounded monthly, the EIR becomes 12.68%, which is higher because of compounding. Why is this important? Because the EIR allows us to fairly compare financial products that may use different compounding frequencies, like monthly versus quarterly versus annually. This way, borrowers and investors can make smarter financial decisions by knowing the real cost or return. Alright, let's talk about the loanable funds theory. This economic concept explains how interest rates are determined in the financial markets. It was formulated in the 1930s by economists Knut Wicksell, Dennis Robertson, and Bertil Ohlin. According to this theory, interest rates are essentially the price of borrowing money, and they are established through the interaction of two forces. Demand for loanable funds. This comes from borrowers such as businesses, for investment, governments, for spending, and individuals, for consumption. They create demand because they need funds for different purposes. Supply of loanable funds. This comes from savers, households, and institutions who set aside money for lending. Their savings provide the funds available in the financial market. When demand for funds rises, like during economic expansion, interest rates tend to go up. Conversely, when supply of savings increases, interest rates tend to fall. In short, the loanable funds theory shows that interest rates balance the needs of borrowers and savers, just like how prices balance supply and demand in a marketplace. The demand for loanable funds refers to the total amount of money borrowers want to obtain from the financial market. The sources of demand come mainly from businesses, who borrow to invest in equipment, factories, and expansion projects, governments, who borrow to finance deficits and public spending, and households, who borrow for consumption, housing, or education. The relationship with interest rates is inverse. When interest rates are high, borrowing becomes more expensive, so businesses and individuals are less likely to take loans. On the other hand, when interest rates are low, borrowing is cheaper, encouraging more loans for investment and consumption. In short, demand for loanable funds rises when interest rates fall, and decreases when interest rates rise, which mirrors the typical demand behavior in economics. When interest rates are low, the cost of borrowing money decreases. This makes it more attractive for businesses to take out loans for investment projects like building new facilities or buying equipment, and for households to borrow for housing, cars, or education. In short, lower interest rates increase the demand for loans, since borrowing becomes more affordable. On the other hand, when interest rates are high, loans become more expensive because borrowers will need to pay more in interest. As a result, both businesses and households may delay or cancel plans that require borrowing, leading to a decrease in the demand for loans. This is a clear example of the inverse relationship between interest rates and the demand for loanable funds. Let's now look at the factors that cause shifts in the demand for loanable funds. A rightward shift, or an increase in demand, happens when more people and businesses want to borrow. This usually occurs during improved economic conditions, when incomes are rising and businesses are confident about expanding. Government initiatives, such as investment tax incentives or subsidies, can also encourage borrowing because they make investments more attractive and less costly. On the other hand, a leftward shift, or a decrease in demand, occurs when fewer people want to borrow. This is often seen during economic downturns, when businesses hold back on investments and households reduce spending. A decline in business confidence or government policies that discourage borrowing, like tighter credit rules, can also reduce demand. In short, shifts in demand are not only about the interest rate itself, but also about the broader economic and policy environment. Let's now turn to the supply of loanable funds. This refers to the total amount of money that savers are willing to lend at different interest rates. The primary source of supply comes from household and business savings, as well as funds provided by financial institutions. The key relationship to remember is that the supply curve slopes upward. Why? Because when interest rates are higher, people are more motivated to save and lend their money since they earn more in return. On the other hand, when interest rates are lower, the incentive to save decreases, reducing the supply of funds available in the market. In summary, the supply of loanable funds reflects the willingness of savers to lend, and it increases as interest rates rise. When interest rates are higher, people are encouraged to save more because they earn a greater return on their money. For example, if a savings account offers 2% interest, you might not feel very motivated to save, but if it increases to 6%, the reward is much more attractive. This also means that higher interest rates increase the supply of loanable funds in the financial market, since more individuals are willing to deposit their money in banks or lend it through investments. In short, higher interest rates motivate saving and lending, which strengthens the pool of funds available for borrowing. So, always remember, the higher the interest, the stronger the incentive to save. Let's now talk about the factors that cause shifts in the supply of loanable funds. When we say the supply curve shifts to the right, increased supply, it means more funds are available for lending at any given interest rate. This usually happens when savings rates rise, when the economy is stable and people have extra income to save, or when the government promotes saving through initiatives like tax incentives. On the other hand, a leftward shift, decreased supply, happens when there are fewer funds available. This can result from lower savings rates, economic recessions where people struggle to set money aside, or government policies that discourage saving. In short, anything that boosts saving pushes the supply curve to the right, while anything that reduces saving shifts it to the left. The equilibrium interest rate is the point where the demand for loanable funds matches exactly with the supply of loanable funds. In other words, it's the rate at which borrowers who need money and savers who are willing to lend are in perfect balance. This equilibrium is very important because it reflects the natural outcome of market forces. If the interest rate is too high, fewer people will borrow, but more will save, creating excess supply. If it's too low, borrowing increases while savings decrease, creating excess demand. The equilibrium rate keeps both sides aligned. Understanding this concept helps us see why interest rates rise or fall and why maintaining this balance is crucial for economic stability. Let's talk about the supply of loanable funds and how equilibrium is established. The interest rate in financial markets is determined where the supply curve of savings intersects with the demand curve for loans. If the rate goes above equilibrium, there will be an excess supply of funds, too many savers and not enough borrowers, so rates will naturally fall. On the other hand, if the rate is below equilibrium, there will be a shortage of funds, too many borrowers competing for fewer savings, so rates will rise. For example, if the government increases infrastructure spending, this raises the demand for loanable funds. The demand curve shifts to the right, which leads to a new, higher equilibrium interest rate, say, from 3% to 4%. This shows how real-world events influence market interest rates. When the economy is growing, both businesses and consumers tend to borrow more, businesses to expand operations and consumers to spend on housing, cars, or education. This increase in loan demand often pushes interest rates higher. In other words, stronger economic activity creates more competition for loanable funds. At the same time, the Bangko Sentral ng Pilipinas, BSP, plays an important role. When growth is strong, the BSP may decide to raise interest rates. The goal is to manage inflation and prevent the economy from overheating. Higher rates make borrowing more expensive but also encourage saving, helping keep economic stability. When inflation rises, the purchasing power of money decreases, meaning the money lenders get back in the future is worth less than when they lent it. To protect themselves, lenders usually increase interest rates, so they're compensated for the loss in value. This is why we often see a direct relationship: higher inflation, higher interest rates. The Bangko Sentral ng Pilipinas, BSP, also steps in to manage this. For example, in 2018, when inflation in the Philippines peaked at 6.7%, the BSP raised its key policy rates from 3% to 4.75%. The goal was to slow down borrowing and spending, helping reduce inflationary pressures. The Fisher Effect Theory by Irving Fisher. This theory explains how nominal interest rates are determined by combining two components: the real interest rate, the true cost of borrowing or return on saving, and the expected inflation rate. In simple terms, lenders and investors want to be compensated not only for the time value of money but also for the loss of purchasing power due to inflation. For example, if the real interest rate is 2% and the expected inflation is 3%, then the nominal interest rate will be 5%. This ensures that lenders still gain a 2% real return after accounting for inflation. Backhand index pointing right. So, the Fisher effect reminds us that as inflation expectations rise, nominal rates also rise, which is why inflation outlook is so important in financial markets. Government actions, through monetary, fiscal, and regulatory measures, play a crucial role in determining how costly or affordable borrowing becomes. In the Philippines, the Bangko Sentral ng Pilipinas, BSP, is at the center of monetary policy. Its primary goal is to manage inflation, stabilize the currency, and promote sustainable economic growth. One of BSP's main tools is the policy interest rate, known as the Overnight Reverse Repurchase (RRP) rate. When BSP raises the RRP rate, borrowing becomes more expensive, which can help reduce inflation by discouraging excessive spending and lending. For instance, in February 2023, BSP raised the rate to 6% to address high inflation. On the other hand, lowering the RRP rate reduces borrowing costs, encouraging investment and consumption. BSP also uses other instruments like the Term Deposit Facility (TDF) and the Reserve Requirement Ratio (RRR) to regulate the amount of money circulating in the economy. In short, government policy, especially monetary policy, directly affects interest rates, which in turn influences consumer behavior, business investment, and the overall health of the economy. Let's now talk about fiscal policy, specifically how government spending and taxation influence interest rates. When the government spends more than it collects in taxes, it runs a budget deficit. To cover this gap, it needs to borrow heavily, usually by issuing bonds. This increases the demand for credit, which can push interest rates higher because both the government and private borrowers are competing for funds. On the other hand, if the government has a budget surplus, meaning it collects more revenue than it spends, borrowing needs are reduced. This can ease the demand for funds, often leading to lower interest rates. For example, in 2022, the Philippine government fixed the interest rates on $11.13 billion worth of USD loans to shield itself from rising global rates. This move shows how fiscal decisions, like managing debt, directly affect interest rates and borrowing conditions. In short, fiscal policy matters because deficits usually drive rates up, while surpluses ease them. This connection highlights why both government spending and taxation policies are crucial for financial stability. Now, let's look at the role of banking regulations in shaping interest rates. Regulations such as reserve requirements and capital adequacy ratios directly affect how much money banks are able to lend. For instance, when the Bangko Sentral ng Pilipinas, BSP, raises reserve requirements, banks must hold a larger portion of deposits in reserve, leaving them with less money to lend out. This tighter supply of loanable funds can lead to higher interest rates. On the other hand, if reserve requirements are lowered, banks have more funds available, increasing supply and potentially lowering rates. Similarly, capital adequacy ratios, which ensure banks maintain enough capital to cover risks, also influence lending capacity. Stricter requirements may limit how aggressively banks can lend, while more flexible requirements encourage more lending. Together, these regulations maintain financial stability but also impact the cost of borrowing across the economy. So, the stricter the rules, the less banks can lend, and the higher interest rates may go. The looser the rules, the more funds circulate, lowering rates. Credit risk refers to the likelihood that a borrower might fail to repay a loan on time, which could result in losses for the lender. Because of this, Lenders adjust interest rates based on how risky they believe the borrower is. The higher the perceived risk, the higher the interest rate charged to compensate for the possibility of default. This extra charge is called the risk premium. For example, if Company A has a strong credit rating and low risk, it might secure a loan at 4% interest. Meanwhile, Company B, with a weaker credit rating and higher risk, could be charged 7% interest. The 3% difference represents the risk premium, which protects the lender against the higher chance that Company B may default. In short, the more reliable the borrower, the lower the rate, the riskier the borrower, the higher the rate. This is why credit ratings are so important in financial markets. In general, the longer the loan period, the higher the interest rate tends to be. This is because lenders face more risks over a longer time, such as inflation, changes in the economy, or uncertainty about the borrower's future ability to pay. To compensate, they charge a higher rate. On the other hand, short-term loans usually come with lower interest rates since the risk is smaller and repayment happens sooner. For example, if you borrow money for 1 year, short-term, the bank might charge 5% interest. But if you borrow for 10 years, long-term, the rate might go up to 8% to cover the added risks. This is why housing loans or business expansion loans often have higher rates compared to short-term credit. The key takeaway, the loan period influences the cost of borrowing, and students should recognize how time affects the risks and returns in financial transactions. Alright class, let's put everything together in a brief summary about interest rates. Interest rates represent the cost of borrowing or the return on lending money, and they play a major role in the economy. The Bangko Sentral ng Pilipinas, BSP, adjusts rates depending on conditions, lowering them to encourage consumer spending, business investment, and higher stock prices, or raising them to control inflation, which often slows spending and can reduce stock values. Bond prices, on the other hand, move in the opposite direction of interest rates. There are also different forms of interest rates to understand, like nominal, real, prime, and effective rates, all of which give us different perspectives on the true cost or return of money. The loanable funds theory explains how interest rates are set through the interaction of the demand for funds, from borrowers, and the supply of funds, from savers. Finally, several factors affect interest rates. Strong economic growth raises demand for loans, inflation pushes rates higher to preserve value, government policies like BSP adjustments or fiscal measures shape overall levels, credit risk makes risky borrowers pay higher rates, and the loan period influences costs, with long-term loans typically carrying higher rates than short-term ones. In short, interest rates connect financial decisions, market movements, and overall economic stability, making them a key concept to master in finance and accounting. Alright. So that ends our discussion. See you again at our next meeting. Keep safe,